Hey, what's up, guys? It's Jermaine. And guys, I've been having a discussion with Leanne today. Most of you will know she's an economist, so she's pretty clued up on kind of microeconomics. And one thing she came down into my office area today and said is, Jermaine, it's just all about inflation right now. Now, you guys will know that I usually think quite a lot about inflation, and particularly from an investing angle. So if you know that prices are going up and the value of your currency, your dollars, your pounds is going down, what does that mean? And how do we make inflation beating investments? That's the hat that I usually wear. But I really listen. So when Leanne looks and says, Jermaine, it's all about inflation right now, I try to pay even closer attention. So what I want to try and do today, guys, is just very quickly give you a few interesting thoughts about how we could maybe try to start beating inflation in our day-to-day lives. So if you see me looking down, I'm just looking at this article. It's from a site called This Is Money. It was written in 2017, and it just looks, obviously then a really different picture in the world around inflation. This article is just looking at a few different things that people were thinking about back then. I'm going to try and update it for you as we go through. So this article says, 6 steps to stop the inflation monster eating your money. From saving to investing, how to get richer as prices rise. So that concept about how to get richer as prices rise is the absolute key thing that we're looking for. So the first thing it talks about is savings. Now, back in 2017, the article here is talking all about looking at high interest savings accounts, whatever that really means. Guys, I know that if you look across the Eurozone, if you look across the UK, and if you look across the States, savings rates are poor. In some places, we're even talking about negative rates, which means that you're effectively paying people to hold your money for you. And that is madness. The way we got to think about this kind of stuff in 2021, in my opinion, is we think about alternate saving sources. So guys, I remain a crypto bull, which means that cryptocurrency as an alternative saving vehicle has got a lot of value in my opinion, and I'm making my investing choices that way. You don't have to do it, but I just want to be really transparent that we've probably got an easy 15-20% of our liquid net worth in cryptocurrency, probably far more frankly, but we definitely keep a very solid portfolio as an alternative saving source. The other thing that we should be looking at, guys, is not just necessarily the bog standard rates that are available on your typical savings accounts, but where you've got things like 401ks or you've got things like ISAs that give you some exposure to the stock market. Now's a chance to educate yourself and maybe think about how you can use market exposure to look for returns. Now, of course, one thing that we were really worried about quite a few months ago was that the printing of fake money could have had a really bad impact on those equity investments. Because basically, if you're propped up by fake money, is it going to be the case that you're going to go under? Are you going to be a little bit more vulnerable? We were not sure. Well, what's happened? Guys, the reality is that a lot of these companies that have been stimulated by QE, by stimulus packages pumping money into the economy, they've still done okay. They're still fine. I think it's got to be a viable option for us, guys. We've got to look and think, can we get a better return on those savings, but maybe by using alternate saving vehicles? It's what we're doing. I'm always transparent with these things. One for you to think about. So the other one that they've got here is around investments. So they're talking about investing. This is primarily in stocks and bonds, right? So nothing too fancy, but it's really getting your brokerage account, setting up a Hargreaves Lansdown, setting up a Robinhood, and getting some money into a fund. Guys, just to be completely transparent, this is one of the big regrets that I've got from the last maybe 3 months. Because what we were seeing across markets was there was a much higher level of resilience amongst equity investments. And there were more questions about whether or not we wanted to get into things like bonds. Equity markets were looking a little bit healthier than we really thought. I think this could be a chance, guys. Just for transparency again, I did some rebalancing of my portfolio last Saturday just gone. And my big move is to be moving back into American and UK equities with a much bigger skew towards the US. Why? Because I think this wall of stimulus that we've seen flood the market, it has actually had a positive impact on stock market prices generally. Now, I can't tell you if I really buy into things long term. I really can't tell you what the impact of all the fake money is going to be. But what I can tell you is that the stimulating of the economies has seen stock markets respond positively. I want some money in there. I want to be a little bit less cautious now, and I want to try and take a little bit more of the upside. So the investing option is still there. And for transparency, we've put a bit more resource into stock markets. So the third thing they've got on this list here is pensions. Guys, for anyone who's been watching Avoiding Broke for a while, I probably don't need to go too much into detail on this one. My personal view is that a pension investment can remain attractive if you are getting a sum of money from your employer that you put in and it doesn't impact you. So a regular pension, like a regular employee pension, not one that is going to be self-managed where you can be far more diversified, including things like investing in commercial property, which I think is a brilliant idea, by the way. But when you look at a regular retail type pension that we get through employee schemes, I think we've got to be careful, guys. Why would we tie our money up for so many years into a vehicle that we don't really have control over, paying big charges, and then we really don't have much access to the money? Why would we do it? I'm not sure. I'm really not buying it. I think it's an interesting idea. And if you are getting a pot of money from your employer that you can invest and it doesn't even touch your regular remuneration, I think that's a very, very different proposition. So I'll speak personally again, guys, just to always give you transparency. I've got many private pensions from different employers that I've worked at, including my current one. I have an amount of money that I'm given as part of my compensation package, and that is just separate from my salary. So I'm fine to put that into a pension, absolutely fine. And I manage it myself, that's the key thing. You know, I'm not paying the higher fees for them to make investing decisions for me. I manage it myself, do my own research, and I spend the time to make sure I try to understand what's going on. So what's happened? Well, I've outperformed these managers, guys, because on Avoiding Broke, we're looking more macro, we're looking more holistic, and we're really trying to educate ourselves, and we've made some good bets. Now, I appreciate not everybody else can do that, but what I do think, everybody can question whether the pension always makes sense in its current form. I would strongly argue that regular pensions in their current form don't always make great sense because you don't have access to them. You pay sometimes high fees for somebody else to manage them. And when it comes to wanting the money, you can't necessarily get it until a point that's out of your control. Doesn't make sense for me and my money. So just for transparency, we self-manage. And if you don't feel confident doing that, you should still ask yourself the questions about if your current setup makes sense. Because what you may find, you may be able to, say, for example, change the funds you've got exposure to, and that in itself may bring down your management charge and leave more money in your pocket. So please, guys, think about this one. So mortgage is a really interesting one, right? So one of the things that these guys are talking about here is the idea that you could pay off some more of your mortgage. It's an interesting idea. It's a combo of switching mortgage rates, but also potentially paying off your mortgage. I think both of those, switching mortgage rates is a given. So for anyone who's currently got a mortgage, if you are in a period of time where you could, firstly, if you could switch with no fee, you should definitely look at it. But if you could switch for a break clause, sometimes it does even make sense. I've triggered break clauses, I think, once or twice. And both times it really made sense for our longer term picture. So if you've got a mortgage, I think it's a great time to be looking at longer term fixes if you're that way inclined. And doing that through switching and considering break clauses, it's not always a bad option. And if you're really unsure, you can speak to your advisor, speak to your broker, whatever it is, and ask them, what is the amount of money you'd be paying in a break clause versus how much would you be saving at your new interest rate over the period of time you commit to? Weigh up, guys, and sometimes paying the break clause is worthwhile. The other very smart thing that you can do if you have got a mortgage is now's the time to overpay. Because think about it, if you could get what looks like a really good rate of interest of 0.5% on your savings, but you could instead, you've instead got your mortgage locked in at say 2%, and you could overpay, well, all of a sudden you're going to start saving money by shipping that money in towards your mortgage, right? You're going to be benefiting from shaving off some debt at 2% rather than saving at 0.5%. That's a very important trade-off, guys, worth remembering. The overpayment option versus the bad savings rate option. Now, for us, we're very aggressive when it comes to these things. So I don't actually pay off. I've got incredible rates on mortgages, but I also don't favor the overpayment strategy because I want to invest more and be leveraged up more. If you want to know more about that, guys, drop it in the comments, and I'm very happy to go a little bit deeper into how we are looking at bigger investing and more leverage. It's higher risk, but also higher reward. But if you're following a more conventional strategy where you're looking just to really have that house paid off, or you're looking to shave off some years, think about the overpayment. It's a very smart move. Okay, so what have we got here? Credit cards. They're talking about basically avoiding credit card debt. Short answer, yes. Credit card debt, unless you're really savvy about how to manage it, is very rarely a good decision. So in short, yes, just avoid it if you're not incredibly savvy about some of the ways you can use credit card debt for your own benefit and how you can leverage up in a smart, controlled way. I don't like talking about it because not many people really are confident doing it. But if you're interested and you do want to know a little bit more about how we can play around with credit cards, drop it in the comments and I will do a follow-up video and give you some ideas about what you could do with credit cards. Again, we don't really like talking about it too much, but if you're interested, drop it in the comments and we'll cover it. And the last thing just to cover here is just in terms of how you manage your household bills. And what it's basically saying is that ensure you switch to avoid going to a standard variable rate. Try and get good fixed rates deals. So guys, look, that's pretty standard procedures, right? If you are locked into some fixed rate deals for many of your domestic bills, what you'll find is there'll be some kind of loyalty component with many of them, and they'll have fixed rates. So just try to extend those. Why? Because you don't want to go into those inflationary type environments with variable deals, because quite often prices are obviously going up. That means the cost of your deal could go up. So just lock into something fixed. Do it for a period of time you feel comfortable with. That period of time differs depending on what type of deal you're looking at. But just be smart, guys. Just remember the value of something fixed with something predictable in an environment where prices are increasing is higher. The value is higher. So just play smart. Guys, that is a very long session looking at the smart inflation beating strategies that you can cover in your day-to-day life. Look, guys, I know that this one is going to be really important for a lot of people. So if you've watched it and you've taken value, please do share it, because we are all living in a high inflation time and we need the strategies to make sure we protect our money. It is massively important. So please share it, because we need to equip more people with more strategies to help us. And guys, if you're watching and you're not yet subscribed, please, again, hit the like and hit the subscribe. The whole reason is the more people we can equip with these strategies is the more people we're going to help on this journey. We're going to help them beat inflation. We're going to help them get returns on their money. We're going to help them avoid broke. And that is the mantra of what we try to do. So guys, until the next AB Daily tomorrow, I hope you have a fantastic day, fantastic evening. Remember to hit subscribe. Hit like if you've not done so already. And please, 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 whichever platform you're on, share this video with your network, because we need more and more people to avoid the inflation trap. All right, guys, I'll speak to you soon. Look forward to it. Have a great evening. Take care. Bye.